Welcome to The Deep Dive. We cut through the noise and bring you the insights that matter.
Glad to be here.
Today, we're digging into a really significant earnings call, Palo Alto Networks Q4 for fiscal year 2025.
Yeah, this one felt like more than just numbers. It was a lot about strategy, AI, the whole security picture shifting.
Exactly. So our goal today is, cut through the jargon, figure out what really happened and what it means for them, and frankly, the whole cybersecurity industry.
Let's do it. It felt like a moment where their long-term planning really started to visibly pay off. You could almost see the strategy clicking into place in the results.
I totally got that sense too. Okay, let's kick off with the headline numbers because, well, they were pretty eye-catching. Palo Alto Networks wrapped up FY25 with a very strong Q4. They beat expectations pretty much across the board.
They did. Non-GAAP EPS. So adjusted earnings came in at $0.95. That was, 6 cents better than consensus?
Yep, 6 cents ahead. And revenue, $2.54 billion. That beat estimates by a decent margin, about $40 million, and it's up 16% from last year.
Solid growth there. Shows the demand is definitely holding up.
And beyond those main numbers, a couple of growth metrics really stood out, pointing towards future momentum.
You mean like the NGS ARR?
Exactly. Their next-gen security annual recurring revenue, that's the predictable income from their newer cloud stuff, hit $5.6 billion. That's up 32% year over year. Pretty substantial jump.
Huge jump. And the RPO, remaining performance obligation. That's their backlog, basically.
Right. The future revenue locked in from contracts. That grew too, up 24% year over year to $15.8 billion.
And the notable thing there, as management pointed out, was that it's the highest RPO growth they've seen in 7 quarters. For a company this size, that's quite something. Shows real multi-year commitment from customers.
Definitely. And on the efficiency side, adjusted gross margin ticked up 90 basis points year over year to 73.2%. That's nearly a full percentage point improvement.
Shows good operational control. And they hit their rule of 50 for the year too.
Ah, yes, the rule of 50. Maybe quickly explain that.
Sure. It's a benchmark for software companies. Basically, your revenue growth rate plus your free cash flow margin should add up to 50% or more. Hitting that shows you can grow and be profitable, which is kind of the gold standard.
Damn, Palo Alto hit that for FY25. So strong performance, strong outlook for next year. The market reaction was quite positive, right? Shares were up after hours.
Very positive. I think investors saw not just the good quarter, but that validation of the strategy we talked about. The pieces fitting together.
Okay, so let's peel back those layers then. These headline numbers are strong, but what do these financials really tell us about where Palo Alto Networks is heading? What's the story underneath?
Well, the consistent top and bottom line beats show solid execution, obviously, but management kept framing it as a result of long-term architectural planning, designing for where the market is going, not just where it is now.
And that big jump in NGS ARR and the accelerating RPO growth you mentioned, that really speaks to durable demand, doesn't it? Customers aren't just buying point products, they're committing to the platform long-term.
Exactly. It signals real stickiness. They're deepening those relationships. Management made a point of highlighting that RPO acceleration versus last year. That's a strong vote of confidence from customers.
And the profitability side, margins expanding, operating margin hitting 30% for the first time.
Yeah, that's huge. It reinforces that rule of 50 story, positions them as, truly best in class for free cash flow generation in enterprise software. And they're aiming higher, projecting over 40% combined FCF margin by FY28.
That's ambitious.
It is, but based on the trajectory, it seems within reach.
And product revenue grew 19%, but the interesting part was how much of that is now software. 56% of product revenue coming from software form factors.
Right. That shift to software-defined security, especially for firewalls, is key. It makes them more efficient, easier to scale, faster upgrades. No need to ship boxes everywhere. It's a fundamental change they're leading.
Okay, so let's shift to what management was saying, their insights and guidance. What was the big strategic theme that came through for you on the call?
Oh, definitely platform consolidation.
Right.
The CEO is really emphatic. Security is no longer a bolt-on.
Right, like trying to secure your house with 10 different alarm systems that don't talk to each other.
Exactly. They're pushing customers hard to move from that messy collection of point products to one unified platform covering network, cloud, AI analytics, the whole lot.
And it seems to be working. They mentioned record platformization deals.
Yeah, big ones.
Yeah.
It suggests customers are buying into that strategic partnership idea. And the payoff. Better security, obviously, but also things like 120% net retention rate for those platform customers. Almost zero churn. That's massive.
Wow. Okay, and AI, that seemed like a huge focus. Gen AI traffic up almost 900%. Data security incidents related to it doubling?
Yeah, the attack surface isn't just growing, it's exploding in complexity and speed because of AI. Think about AI-driven attacks probing defenses in like milliseconds.
How are they respond?
They launched Prisma AIRs, that's their big AI security platform, and they acquired a company called Protect AI, specifically to secure AI models and how employees use third-party AI tools. They're building in things like data loss prevention for AI.
Makes sense. It raises that question, though. Can security keep up with the speed of AI threats?
That's the billion-dollar question, isn't it? It forces the issue of integrated, fast response.
And speaking of new vectors, they highlighted the enterprise browser, calling it the new operating system for the enterprise. That's a strong statement.
It is. The idea is that so much work, especially with AI and cloud apps, happens in the browser now. Securing that becomes paramount.
And their own secure browser offering, Prisma Access Browser, adoption is picking up.
Significantly. Seat count more than doubled just in the quarter, hitting over 6 million cumulative seats. It shows that need is real.
Okay, now the bombshell news. The plan to acquire CyberArk. Roughly $25 billion cash and stock. That's a massive deal.
Monumental. The goal is clearly to fuse identity security, who gets access to what, right into their core platform.
Why now? Why identity?
Management sees identity as hitting an inflection point, driven by what they call agentic AI, AI that can act on its own. Suddenly, knowing exactly who or what has privileged access becomes absolutely critical.
Yeah.
This deal aims to lock that down, boost cross-selling, and stop attackers moving laterally inside networks.
It's a big strategic bet on where security is headed.
Absolutely. And it complements a platform story perfectly.
And on the leadership side, founder and CTO Nir Zuk is retiring. That's a big change after 20 plus years.
It is, but they seem to have managed it smoothly. Lee Klarich, a longtime product exec, is stepping up as Chief Product and Technology Officer and joining the board. Seems designed for continuity.
Yeah, suggests a deep bench, like you said. Okay, what about cloud and security operations? Cortex and cloud. Combined ARR up nearly 25%. What's the story there?
The big push is moving beyond old school SIEMs, collecting logs after the fact towards real-time runtime security, stopping attacks as they happen.
And that's where XIM comes in, their autonomous SOC platform.
Exactly. It's their fastest growing product. The whole point is slashing response times, mean time to respond. MTTR. They're talking about going from weeks down to minutes. Over 60% of customers using it are apparently seeing MTTR under 10 minutes.
That's a game changer, if true.
It really is. And Cortex Cloud focuses on unifying security within the cloud environment itself. Again, proactive, real-time defense.
And it sounds like they're finding new markets just by using the data their platform collects.
Yeah, they call it their data-to-market engine. Because they see everything on the platform. They can spin up new modules for things like exposure management or email security. They see that as an $18 billion opportunity starting in FY26.
Wow. Okay, and finally, the guidance for fiscal 26. You mentioned it was strong.
Very strong. This was standalone guidance, so before factoring in CyberArk. Revenue projected between $10.48 and $10.53 billion. Non-GAAP EPS, $3.75 to $3.85, both well above what the street was expecting. Solid Q1 guidance, too.
Clearly fueled that positive market reaction. Okay, let's take a step back. What does all this mean in the broader context for you listening investors, tech folks, anyone watching this space?
Well, Palo Alto is clearly positioning itself as the consolidator in a still pretty fragmented security market. Their goal, they say, is to go from mid-single-digit market share to maybe 15, 20% through this platform strategy. It's ambitious, requires, as they put it, heads-down execution.
And AI seems to be pouring fuel on that fire, right? Driving the need for integrated solutions faster.
Absolutely. The sheer speed of AI-driven attacks, they mentioned potential attacks unfolding in just 25 minutes, makes fragmented security setups almost obsolete. You need that integrated, fast response. AI is forcing the consolidation issue.
But competition is still fierce. CrowdStrike, Fortinet, Zscaler.
Oh yeah, it's intense. Palo Alto's pitch is that their platform is truly comprehensive, that single pane of glass across multi-cloud. That unified view and control is their key differentiator against more specialized players.
And the big deals seem to back that up.
The momentum there is significant. They had one of their strongest quarters ever for large deals. Customers spending $5 million or $10 million in ARR were up around 50% year over year. The really big ones, $20 million plus ARR customers, up nearly 80%.
Wow.
That shows the big enterprises are really buying into the integrated platform vision.
So the strategy is clear: evolve from the firewall company to the full stack security cloud provider. Integrating identity via CyberArk is key. Maintaining margins is key. It all feeds that platform narrative.
Exactly. If they pull it off, they could really become the foundational security layer for the modern enterprise.
All right, let's switch gears a bit. Time for our This Is Not Financial Advice segment. Think of this as us throwing out some maybe slightly wild but plausible trade ideas, like analysts brainstorming, purely informational, just for fun.
Definitely not advice,
Okay.
just connecting dots based on the call themes.
Yeah.
Speculative fun.
Okay, idea one. Let's call it the identity firewall, long short. The thesis: Palo Alto is all in on identity being reshaped by AI, hence the CyberArk deal. So maybe you go long pan W.
And pair that with a tactical short position against smaller, pure-play identity vendors, the ones without that broader platform or deep AI integration.
Right. The idea is, as enterprises demand that seamless, real-time identity security built into the platform, the standalone guys might struggle. Their value could diminish relative to Palo Alto's integrated approach, especially with AI threats raising the stakes.
Market rewards the consolidator, penalizes the silo. Could be an interesting dynamic.
Okay, idea two. The browser as OS, short the unsecure edge play. Palo Alto is really hammering this idea that the enterprise browser is the new critical control point, the future OS for secure work.
So if you buy that, maybe you go long pan W again because they're pushing hard with Prisma Access Browser.
Yeah.
And you offset it with a short or underweight on legacy security players' endpoint, or maybe some SaaS vendors who aren't deeply integrating secure browser capabilities.
The thinking being, as work and AI shift into the browser, companies that can't secure that specific vector will look increasingly risky. An unsecure browser becomes a massive liability.
Yeah, the market might start valuing integrated browser security much more highly, potentially punishing those who lag behind in securing that new operating system.
Again, just thought experiments based on the call's emphasis. Okay, wrapping things up.
It was definitely a strong quarter for Palo Alto Networks. Big financial beats, strong growth in the key NGS metrics, expanding margins. The core business looks healthy.
And that platform strategy seems to be hitting its stride. The large deal numbers, the customer retention, it suggests the message is landing.
The CyberArk acquisition is the big strategic swing, a bold move into identity, betting heavily on that AI-driven inflection point. It really doubles down on the platform vision.
And while the leadership transition is notable, Nir Zuk retiring, the markets seem pretty comfortable with Lee Klarich stepping up, especially given the strong guidance for FY26.
Yeah, the forward look seems to emphasize ongoing innovation, deeper integration, and really capitalizing on this security upgrade cycle that AI seems to be driving. They're definitely trying to shape the market, not just react to it.
So lots to think about there. We'd love to hear what stood out to you from this call. What questions does this spark about the cybersecurity landscape or your own strategies?
And just that final reminder, of course, everything we talked about today is purely for informational purposes. It's not financial advice. Always do your own research before making any investment decisions.